Welcome to Plus TV. Today we have David Martin of Martin Fund Management, a 25-plus year veteran in trading soft commodities. And in the last 2 years, he's launched a CTA and a fund to capitalize on his expertise in the soft commodities and ag space. Now, David, can you give us an introduction into your history and how you got started?
I came to New York to work on the commodity trading floor. I worked for this firm called Cooper Neff and Associates. They were an options market making firm. And I was a rugby player in school. I came to the trading floor. I saw the environment. I loved it. I wanted to work there. We were mostly a group of quantitative options traders, but we had our own mock trading sessions where we trained each other. It was fantastic. And so each day we were ready for the markets. We had extreme risk management training. And every day we attacked the trading floor and did really well for a number of years. After about a year of clerking for some of what I think were the best traders in the business, they gave me a badge, they put me in the pit. At that point I started trading for the firm's account, and I started to notice some correlations that existed between the different markets, particularly in soft commodities, things like coffee, sugar, and cocoa. A lot of guys are most interested in trading their front month paper, but there were these spreads to trade. And yeah, some people were trading them, but they weren't really paying attention to the correlations I started to see. I started trading in 1991 and started developing a trading system programs based on the different correlations in the spread trading that I noticed at the time. Over the years, I lived through many multi-year cycles and developed my trading model based on the information that I saw. My data for my career is not back tested. It's something that I've lived and have actually traded it. After working for them for a couple of years, I had developed my trading system that I'm using today, actually, and I wanted to go out on my own, so I did. In 1994 was a crazy year, particularly in coffee. There was a double frost, and I had my first $1 million year. My programs worked. So I continued to build on my systems at that point. After '94, I felt that I had the capital and the opportunity to really grow my business. And so at that point, I started looking at other markets and saw opportunities with my trading program that I didn't realize were there. And so I traded them, I ran with it. 1997 was another great year. And also it was the kind of job at that point where every day felt exciting. There was always opportunity. I continued to grow and expand and do very well personally. Traded through up to 9/11, which was very difficult. I lost a number of friends that day. Took some time off from the markets, came back 2002 and continued to trade my system. The markets continue to grow in terms of open interest and participants and that sort of thing. When ICE came along to buy the exchange, it became apparent to me that the business was going to change drastically. And so what I did at that point in 2006 is I took a few years off and spent time adapting my system to a different trading environment, to a purely electronic execution method. That took some time. It took 2.5 years. I made a lot of changes to it, tested it in other markets. It worked okay in some of the other markets, but it continued to perform well in the softs. Came back in late 2010, early 2011, put my system into production, and it had one of the best years of my career in 2011. At that point, being a member of the exchange, what that meant to be a member of the exchange was changing. It was no longer you had rights and privileges and cheaper fees. All of that was changing. It was apparent to me that it was really just an electronic trading platform, and it was no longer good enough to have $500,000 or $1 million in your trading account. They wanted you to have $5, $10, $50 million. It wasn't about being a prop trader on the floor anymore. It was about being a money manager or a hedge fund or a bank.
So David, when did you actually decide to launch your fund?
In 2012, I spent most of the time laying an institutional infrastructure to form the advisor firm Martin Fund Management in order to trade outside capital. In the beginning, we started very small, just with 4 managed accounts, family and friends sort of thing, right around $1 million, and we had a great first year. I made some relationships in the industry. We took on more capital. 2014, we had a great year. At this point, we're over $25 million assets under management, but that's about to change drastically because of the niche markets that we trade, because of the uncorrelated nature of the markets that we trade, and my experience and my trading program and our track record, I think we're starting to gain some serious traction with institutional investors. Because of the niche strategy of what we do, I mean, these are niche markets in the first place. It's coffee, sugar, and cocoa. I mean, these are soft commodities. They're uncorrelated to the macro in general. The fact that I have a spread strategy that I've been trading for the past 20 years, and it works. I mean, not a lot of people can say that. Like, the data I've traded, the things that I do, are not things that I back tested. I've lived them. I've traded this stuff. Because of the nicheness of it, because of the quality of the infrastructure that I'm building, we're starting to attract a lot of institutional investors. In fact, we're currently undergoing due diligence by 3 large institutions, one in California, one in Hong Kong, and one in Chicago, that if they come to fruition, it's going to drastically change our business. So I'm very excited about that.
Tell us about the actual fund and the strategies that you run.
So the actual fund is called the Martin Fund LP, and it's based on my trading program that has 3 strategies. The first strategy uses options to express the advisor's overall market opinion. The second strategy uses spread arbitrage, or the spread butterflies that we discussed. And the third strategy, our key strategy, is based on the Goldman Sachs Commodity Index roll.
So tell us more about these institutional investors and their commitment to your firm. What are they looking for in your strategy?
I think the institutional investors are interested in these markets because there really aren't a lot of people who are trading coffee, sugar, and cocoa in particular. I mean, they're niche markets. There is not a lot of people with experience in these markets, particularly the kind of experience that I have lived through, that are still trading them today, especially for outside money. People look at the volatility of things like coffee and sugar and cocoa, and they're attracted to the opportunities, but when they go to trade them, they often get hurt because they don't understand the fundamentals behind each commodity. Each commodity has its own orbit that it works within, and yes, they move a lot, and yes, they're volatile, but I feel that our system captures that volatility, and as a trader, I think that's a good thing. These commodities have an inherent volatility for a fundamental reason. Coffee, in particular, is not grown on a large corporate farm with large combines that come through and collect it all with, agrometers and water meters and technology. I mean, there are a few places in South America like that, but the vast majority of the crop is still grown like it was 150 years ago on hillsides, harvested by hand with animals coming down the mountain. I mean, just as you would imagine it, it really hasn't changed.
Commodities are generally perceived to be very uncorrelated to the rest of the market. Now, given your area, it's very niche, soft commodities. How uncorrelated is your strategy specifically?
Coffee, sugar, and cocoa in general are uncorrelated from the macro world. I mean, they are drinks, but if people can't have their coffee, they freak out. So it has its own market elasticity. It doesn't really respond to macro factors. The dollar, crude oil, the stock market can be doing their own thing. Coffee is going to circle in its own orbit. Same thing with cocoa. They're really more dependent on factors that are inherent in those particular commodities and not so much the macro. So a lot of institutional investors, funds of managers, if you will, who are looking for exposure in this sector will be drawn to a sector specialist like myself because we understand these commodities, and they will take us and mix us in with other managers in their portfolio. And it's attractive for them because they diversify their risk, they pick something that's uncorrelated, and then together with the other managers in the portfolio, they have a well-balanced investment, I think.